Hello and greetings. Oh, excuse me, Forex Academy users, subscribers, and members, and welcome to this video. This is a continuation in our series of trading psychology, risk management, and trading methodology. And this video is going to go over parts of the that falls into the risk management and trading methodology components here, more in line with the uh, uh, looking at the method component. We're going to talk about price correlation, price cycles, and deleveraging as a strategy. So in Forex, we have a whole bunch of currencies, right? We have really a huge amount. If I pull up my Optima software and if I want to, um, you know, well, actually, we'll look at this right now. We'll just go over price cycles. So everything likes to travel in a cycle. And so that the dollar Swiss is kind of a good example of what the dollar index looks like. And so these are all of the currency pairs that I have here listed that I trade either frequently or every once in a while. So we have the Aussie dollar, New Zealand dollar, Aussie dollar, US dollar, New Zealand dollar, US dollar, New Zealand dollar, Canadian. So the Kiwi Swiss. We have the pound, Swiss, the euro, Aussie, pound dollar, and so forth. We can see all these. And so this is called a relative rotation graph, right? And so it's separated into four quadrants that tell us what, are the conditions of these forex pairs versus the dollar. And so when something's in improving, that means it's rising. And then when it's into leading, that means it's approaching its apex. And so we can see that while a lot of things do move in the same direction, not everything moves in the same direction. And so we can see where some clear underperformers are. So we can see that the Aussie dollar currently is definitely lagging and underperforming the entire broad market, all the other pairs are. So what this is telling me is that there is a high probability of this turning around and going from lagging into improving and then into leading again and so forth. All right, but that's market cycle. If we take a look at the dollar index, though, I want to get into price correlation. So the dollar index, and this is something I think all of you should have on your chart, on your watch list. When you're using TradingView and you're in current holdings, just go to add symbol, type in DXY, and it will be under CFD. And all the dollar index is, it's a basket of currencies, other currencies versus the dollar. So you've got the euro in there, the British pound, the Japanese yen, the Swedish kroners in there. I think what else is in there? There's been talk about redoing it because it should have things like the Canadian dollar in there and others, but it's a representation. This is kind of an aggregate view of all the other currencies versus the dollar. How is the dollar doing? So clearly, looking at this chart, the dollar's been doing very well against any currency, any forex pair that is a dollar pair. So like the pound, the Aussie dollar, New Zealand dollar, the euro, the Canadian dollar, anything that is pitted against the U.S. dollar right now is in a bearish mode compared to the dollar itself. And so when we're looking at correlating pairs and we're trading, the thing we got to pay attention to is that, if we are, for instance, and you got to think that most of the time things move in a correlative manner. And so things that are paired against the dollar, if the dollar is doing well, they're probably both moving in the same direction. They're probably both moving down. One second here. I'm trying to pull up this example here on a site. Okay, so if we know that the dollar has been up, that means we should probably see two major currencies like the pound and the euro be down. So let's look at the pound. Obviously, that has been in a down move. What is the euro dollar look like? Obviously in a down move. So when we see that we have this inherent weakness of other currencies, but the dollar index is doing well, then it's really a good idea not to trade against that trend. Okay. Same with, while if your time frame is a daily time frame, you probably don't want to be taking a long in the euro and then also be shorting the pound unless you're doing it to hedge. All right, unless you're doing some hedging, if you want to consider that a hedge of sorts. So that is one way to look at that. That if you're going long in the pound and going long in the euro when the dollar's doing very well, that's kind of a risky trade. You have two pairs that are not performing well against a high performing dollar. Similarly, another good example is if we look at the yen. There's a yen index, well, the JXY. Not as used as often, but we can see that any of the yen pairs, like here's the, well, let's look at this chart. Let's look at a cleaner chart on a daily. So we have, this is the pound yen, and then we have the dollar yen, and then we have the euro yen. Where are you at? Actually, we have the Aussie dollar yen. With the exception of the dollar pair, right, of the dollar yen, a lot of the other yen pairs, they move together as well. And if you don't like to cycle through all that, there's a great website, Oanda. They have a heat map of the correlation between the pairs. So if we want to see what the correlation between the euro and the Aussie dollar is, we can see that on a 1 week basis, the euro dollar and the Aussie dollar US dollar pair, they have a high correlation with one another. Where they are the opposite is, let's see, we have the US dollar Canadian dollar. They are negative correlation. All right? And we have some where there's not a lot of correlation, or we have periods of time where some instruments have a zero correlation over a long period of time, but they have a shared correlation in a short amount of time. So just kind of watch out for that kind of activity. It's a very good idea to pay close attention to how pairs are moving. And I want to point out that if you see that the pound and the dollar are, if you see the pound and the euro are both, doing poorly against the dollar, then you can also imagine that they're probably not, doing great against each other either. I think this is a pretty indicative chart of indecision. So ever since the dollar's been bullish, this is the euro pound. So this is the euro's performance against the pound. And we can see it's a pretty tight range here. I mean, we haven't had a lot of movement. And so trying to pit, this is kind of adding further evidence to, that there's really little sense, unless you're trading some news, to be going, long on one pair and short on the other. It's just very, very not necessary. Are there times when, during this bull move in DXY that we've seen the euro or the pound outperform each other? Yeah, certainly, definitely. But for the most part, it's been a pretty tight back and forth. They have been very they've had a lot of correlation to each other. If we look at the euro dollar versus the euro pound, we see a high correlation over or very strong correlation over the 1 week and 1 month. But let's see, we want to do the pound dollar, and we want to do the euro US dollar. If we look, they have very strong on the weekly, the pound dollar and the euro dollar pairs, very strong positive correlation on the weekly, the monthly, the 3 month, the 6 month, and the 1 year. Okay, pretty much if you're going to go long in the euro, you might as well go long in the pound. And there's really no sense in trying to get a trade opportunity to the inverse of one versus the other. The only time that you would probably want to go short and then long on the other is if you're hedging your trades, if you care to do that. Otherwise, there's really very little reason why you'd want to do that. It's just there's really no sense in it. So, just be aware of that. We also want to pay attention to price cycles. Ooh, price cycles. Things travel in seasons and cycles. I'm a Gann trader. That what you're seeing on your screen is a very, very typical of a kind of a Gann setup, and so this is how I trade, and things travel in cycles, and depending on anything else you trade, your familiar cycles. But one thing that you should pay attention to is where important highs and lows are found. So if I'm looking on a daily chart of the pound, I'll get rid of this here. I want to take a look. Where was a really big high found? I'm going to say, let's see, right up here in July, middle of July. And then let's see if we have a higher low found in the next July. So that was July of 2014. I want to go to July of 2015. June-ish here. And here's the same time period in July. Want to do July of 2016. Then I want to do July of 2017. And July of 2018 is up over here somewhere. Let's just kind of go back. Were there any other high Julys? So July of 2013 actually was a low. July of 2012. There was a low. July of 2011. We're kind of at a swing low. You're probably seeing something happen here because this is actually very, very good to notice, because as a Gann trader, I pay attention to July a lot. Okay, so the point is what seems to be the pattern? What seems to be the price pattern here with the pound dollar in July? Is it near a swing low all the time? Not really. Is it always near some type of swing high? Not really. But what is it generally? It's generally at or near some type of short or long-term swing high or swing low. July is common to see the yearly high or low in any instrument. It doesn't matter if it's commodities, equities, futures, forex, cryptocurrencies. July is an area where you're going to find very frequently new highs or lows for the year, or new support and resistance levels for the rest of the year. All right, so if we look at our charts and we see that we have come down to some type of swing low, we can see in July, or a swing high, we can see that we have a high probability that is the new higher low for the year. And then if we ever cross it above or below it, we can assume to be bullish or bearish. So this is a very common, very normal type of cycle in price. The other time period we want to look at is December 22nd. Let's look at the euro dollar. And let's go all the way back if we can. So I want to find December 22nd, or just around that area. So here's December. There's December 22nd. And that was what, 2005? We need to do December of 2006. Oops. And December of 2007. December of 2008. 22nd, or close to it, that's fine. Then we want December of 2009. You're probably watching this and going, oh my God, it can't be that easy. Well, it is. This is behavioral trading psychology. This is evidence of cyclical nature of markets. This is evidence of the cyclical nature of human behavior. And as I'm doing this, you know, the thing is that markets are like anything else in creation. They are very orderly, even though they appear chaotic. And certainly in the short term, humans can be responsible for some aberrations in price, but for the most part, actually not for the most part, it's just a fact that humans are unable to dictate the change of a trend in price. We are slaves to a preset pattern that we cannot alter, even if we tried. And anytime we deviate strongly from that pattern, we experience violent reactions in time and price. And December 22nd of 2017. And there we go. Okay. So, looking back here, scrolling all the way out, December 22nd is a very important date in price cycles in Gann's work, where we usually will start to see the culmination of a trend or the beginning of a strong reversal in a trend. And we can see that if the December 22nd isn't like right on a type of major swing high or swing low, it is certainly around that area, okay? Because it's not like an exact date, all right? You have to give it some variance in there. So if we really look, if we start with the first one that we have here, you know, we see that there is kind of a swing low here on the daily, followed by some type of, it's not really a swing, but it's in the middle, definite swing low there. This is interesting that we had this big rise and then we had a fall as we were approaching this cycle here. This December was the high of the year going forward. It was not breached. December to December is pretty flat. December to December pretty flat. December to December pretty flat, but then we traded down, traded pretty flattish, but we were at a low, traded up, and so forth. So there's a lot of cycles associated with price and times and dates. And the other one that you want to pay attention to is you can go to your let's go to the DXY, and we could go to like a weekly chart, and we want to find the major swings and identify those dates, those weeks, those months, and figure out, okay, is there going to be some type of market high there again? Because anniversary dates for price are important. So I'm going to say, let's see, we have, we'll just do this one first. So there was a swing high here in June. All right, so I want to look for June in the future. So June of oh wow, this is all the way back to 89. So let's look for June of 1990. You know what's going to make this easier if I just go like this. June of 1990. Was there some type of swing high there? Oh yeah, there was. Right there. Go to the June of 1991. Was there some type of swing high there? Oops. Wait a minute, that's not right. Hold on a second. There we go. There's June. June of 91. Somebody's probably thinking, why don't you just put it at 365 days? Well, because I'm on a weekly chart. So we're in June. Are we in June? No, not quite. We are. There's our June. That ended up being at or near a swing low. June of 93. June of 94. Okay, and you know, let's just go to the current past few years and see if that has held up. So that was back in 89 all the way to the early 90s. Let's see, what do we got here? We've got let's go to June of 2009. What do we got here? Not much to say. June of 2010. Oops, where are we at? There was a high. June of 2011. Some type of bottom. June of 2012. June of 2013. June of 2014. June of 2015. June of 2016. Wait, was that 2015 rather? Wait a minute, what is this? Yeah, June of 2016 is what I need. Right there, and then June of 2017. All right, that pretty much what we're seeing is that June, the month of June, appears to be an area where we see a lot of swing highs and swing lows being found in the dollar index. And how does that correlate to what we've talked about since the beginning of the video? Is that the dollar index is a representation of a basket of currencies and their performance against the dollar. So if the dollar is at some type of swing high or swing low in June, what are the odds of the price action as moving forward? Because we're in June right now. At the recording of this video, we're in June. We're going to be at some type of a swing high. What's the behavior? We're going to have a counter trend move. Counter trend move. All right? This is super important stuff. And you know what? It seems ridiculous. I know it seems ridiculous, but one of the methods of successful trading is understanding seasonality and anniversary dates and historical price action, because things move in patterns, all right? It doesn't mean that every single June we're going to have a swing high. It doesn't mean every single June we're going to have a swing low. But what it does mean is that we have a very, very high probability of June being near a swing high or a swing low. And that can help not only in our forecasting, but it can help in our trading, because if we know that this is a swing high and we're in June and the behavior after this is to see prices drop for the year, then we know what direction to trade with a high probability of success for the rest of the 6 months. That's pretty good, isn't it? Most of the confusion that people have is trying to determine, well, how do I know when to go short or long? You know, if I'm looking at a 1 hour chart, but how does that relate to the daily and weekly long-term trend? This is how you do that. You determine where prices are at according to a cycle, and then find the probability of the direction of the move, and then trade in the direction that the highest probability is going to be. So for the dollar index, using my style of market geometry here, I know that June is near market high. This is a pivot in time. We're inside of this law of vibration. We're at this not all-time high, but we're at this multi-month high. And that the behavior here is for price to go down. All right? We should see limited further upside movement and more downside pressure. All right? Okay. Thank you for watching this. I look forward to talking with you, excuse me, in our other videos. Bye-bye.